Could you give a layman explanation why yield flattening and yield curve inversion causes pain for banks and typically leads to a downturn? Curious to know the why as well as which leads which. Downturn perpetuates yield flattening or yield flattening perpetuates downturn. So great question. Well, actually questions. So we've put a couple slides together just to sort of give a little bit of context here. So maybe we'll go to the first slide here, slide 4. And so this is looking back over the last, I guess, 23, 24 years, sort of back to the early days or inception of the XLF, just to give a little bit of context. So what we're looking at is the blue line there, which represents the 2-year, 10-year Treasury yield spread. That's on that sort of left-hand y-axis, but it's inverted. So that's important to note. And so when you see these peaks in the blue, that's actually troughs. And then the black line represents the XLF, the price. And I guess we could have done a log scale there, but that's all right. So anyway, just thinking about sort of what we see in this chart, really 3 periods since this chart began in the late 1990s when the yield curve has been negative. The late 90s, early 2000 timeframe, the GFC period, and more recently, the 2018, early 2019 timeframe. So if we think about each of those periods and ultimately what followed, we saw significant declines in the XLF. So we show that in those 3 red arrows. So, the most important takeaway is that the inversion of the yield curve, or the yield curve becoming a negative number as opposed to a positive number, the yield spread, is bad, or at least historically it has been, for the financial sector at large. And there's a couple reasons why. The first thing to realize is that think about sort of what's happening with the yield curve. So if you think about, you take a step back and you think about the 2 pieces of the yield curve, in this case, the 2-year and the 10-year Treasury yield. So the 2-year yield is going to be a pretty good proxy for what the Fed is doing. So as you can see, most recently, the 2-year yield has moved up at a blistering pace since roughly September of last year. Now expectations are for 6+ rate hikes over the coming 12 months. So we've had this very significant move, and the 2-year is really a reflection of what the Fed is going to do, or people expect the Fed to do. The 10-year yield is different. The 10-year yield is set by the fixed income market and is really a function or reflection of what the fixed income market sees as the outlook for economic growth. And so what ends up happening is that as the fixed income market sees the prospects or outlook for growth deteriorating in the future, usually about 1 year out, they start to push down the yield at the long end of the curve. In other words, they're buying the long end of the curve to lock in that higher yield because they expect yield on shorter term paper is going to fall because the growth is, or the Fed is going to go the other direction and switch from being hawkish to dovish. And therefore, yields you can secure on a shorter duration basis are going to fall. So that's a big piece of what's going on. So one thing to sort of think about in the context of financials is what are the implications of that from a credit quality standpoint, right? So if we're talking about banks, if we're talking about any kind of lender, obviously credit quality is paramount. Generally relatively easy to give money away, not as easy to get it back. So the concern is that when you have growth problems, when the economy slows down, that's generally going to be associated with a rise in unemployment, a rise in business defaults, and generally credit quality of the loan portfolio is going to go down. And so whenever that happens, you see prices and multiples across the financials landscape compress. because there's concern over, what's ultimately the damage going to be here. So obviously the most sort of stark example here is the GFC. The start of the pandemic was the second most significant example, the late 90s, early 2000s, the sort of, least significant of the three, actually. So that's sort of the first thing, is that the yield curve is telling you, the yield curve inversion is telling you that the fixed income market is concerned that there's going to be a growth problem, probably a recession. And so that tells you that there's going to be an earnings problem for financials down the road, as they have to provide greater loan loss reserves against an expected deterioration in the loan book quality. The second thing going on, so there's the credit side is one piece. The second thing going on is that if you think about lenders, they're spread lenders, right? So they are funding the book with deposits and shorter term securities. And then they are lending out generally on a longer term basis. And so the steepness of the curve is generally going to correlate quite strongly with the profitability of their book. So if you think about like the classic example, you would be funding a 30-year mortgage, let's say at 5%, with short-term rolling deposits, let's say at 1%, right? And obviously, the spread is the net interest income for the lender. So to get a little bit more nuanced about it, generally, banks are set up, so they have what's called an ALCO, or an asset liability committee, that gets together regularly and thinks about how they should be risk managing the rate environment. And they will position the balance sheet of the bank to be either what's called asset sensitive or liability sensitive. So if they are asset sensitive, what that means is that on a 1-year basis, more of their assets will reprice than their liabilities. In other words, if rates move up, they will benefit from that because the assets will reprice faster than the liabilities. Conversely, if they're liability sensitive, the exact opposite would hold. If rates were to move up and you were liability sensitive, then your liabilities reprice more quickly than your assets. So that's going to be a problem. The problem generally that banks have is, one, the asset liability committees tend to not get these things right very often. And two, most of the assumption is that you're going to see what you would sort of think of as a parallel shift in the yield curve. In other words, steepening and flattening tend to be sort of, lesser or secondary considerations, right? So that's the problem. So you're seeing the short end of the curve going up, great, but that presumes that the long end is moving up as well. But in fact, what we've seen is that the yield curve has flattened dramatically and is now back down to around 40, 45 basis points, or all the way down to 40, 45 basis points. And interestingly, if you look at the 1-year forward 210 OIS, or overnight index swap, so in other words, what the fixed income markets think the 210 will look like a year from now, it's actually negative. So it's negative 5 to 10 basis points. So basically the expectation is that within a year's time, you will actually be inverted on the yield curve. So those are the two factors. Then there's also sort of a pro-cyclicality to lending. So if you go to the next slide, this is actually looking at the senior loan officer survey data going back to 1990 for C&I lending. And we're looking at spread standards and demand. So what are your underwriting standards? Are they tightening or are they easing? What are your lending spreads? Are they widening or are they narrowing? And what is the demand you're seeing for C&I loans? Is it growing or is it shrinking? And generally what you see is that you tend to move through underwriting waves. So in other words, what this chart shows is that these periods in green represent periods where credit standards are easing. In other words, underwriting is generally becoming more easy. Loans are becoming more available. Demand is positive on the margin. There's more demand for loans, and you're seeing spreads not widening. Conversely, when you go into these red periods, these are periods where banks are taking losses. And again, underwriting is very pro-cyclical. So as things are slowing down, they're actually getting tighter, right? So this is the sort of reflexivity of banking and its effect on the credit cycle and on the broader economic cycle. And so that's the other point here, is that as the yield curve moves into negative, it's reflecting expectation of growth slowdown. Banks will look at that and they'll start to pull their horns in as they see that beginning to manifest. And then you get this sort of self-fulfilling feed forward loop. So that is kind of a quick, hopefully reasonably decent explanation for what's going on there.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.